Now, Sonia, I think you and I could both agree on this. We could all use a little more money in our pockets right now.
Especially this time of year. Yeah, and
This time.
today, Tony Torino from Barnum Financial Group is here to give us tips for year-end tax planning. Welcome back, Tony.
Yes,
Thanks for being
good to
here.
have you
Thanks
here.
for having me.
And we're taking a look as we head toward the end of the year. How does someone minimize their tax burden as we head into 2010?
Well, I think the first thing that you want to do is you want to definitely talk to your tax advisor. And I think that's what a lot of people overlook, is that they don't take the time to make that call and say, here's my situation and what should I do. And I think what you also have to be aware of, it's not just about this year, it's about next year, the following year. Your tax advisor would know if, well, let's say, for example, this year you have a higher income, next year your income may not be as high. Should you take advantage of certain things this year opposed to next year? But one quick note that I would say is just take a quick look at some of your capital gains and losses, see if you might be able to offset and reduce some of your tax burden. And I would definitely always just talk to your tax advisor and ask them the questions. Is there anything I should be doing? They know your situation. They're going to help you out.
Right.
And Tony will help you out. And if Tony is your financial advisor, you're going to ask him the next question. And that is, if you're paying additional taxes and you definitely want to file for your tax return, but you're asking yourself, okay, is it better to have your more money withheld for your weekly or biweekly paycheck? What do you say to that?
That's 100% preference.
Okay.
It really is. If the more you have held, if you know you're going to get a refund back, you're given a loan. Or you can take it, and some people say, well, give it to me today and I can invest it myself. That's preference. If that was me, I would take it. Personally, I would take it. But that's preference to whatever the person would like. There's either way. You're going to get it. If you're overpaying, underpaying, it's going to all work out in the end.
Okay.
Also, in January, I think a lot of companies offer open enrollment where you can make changes to your 401k plan. And we had seen a lot of companies, the way the economy was going, they had taken away matches or suspended them for your 401k. But are you seeing companies might now reinstate them? And if so, should we just jump in at that opportunity?
Absolutely. If a company's going to offer you free money, they're going to match you, you have to take at least advantage of that. I would say that that's a must or a given. What I would tell you is given what's happened over the last year, a lot of people have seen wealth created and taken away. Our retirements are going to be much more dependent on ourselves rather than somebody else taking care of us or Social Security or something. So I would tell everybody that I would start getting back in. I would definitely take advantage of that.
All right, good to know. Let's talk a little bit about the difference between Roth 401ks and then, of course, traditional 401ks. Can you break that down for us?
Absolutely. A traditional 401k is pre-tax dollars. So you're getting a nice tax deduction up front to put the money in. The money will grow tax deferred, and when you take it out, it comes out as income. Very simple. That's the way it's always been. Legislation changed, and they formed something called a Roth IRA, which then became a Roth 401k. The key difference between a Roth 401k and a Roth IRA is the ability to put money into it. A Roth IRA has income restrictions, so if you make too much money, you can't put into it. A Roth 401k doesn't. Now, when you put into a Roth 401k, you're not going to get that tax deduction up front, but the money will grow tax deferred, and when you take it out, it's tax-free. So what you have to be aware of is right now, that and what the tax brackets are going to be 20 years from now, I have no idea. But what I do know is tax-free money is nice. So that's a question to sit down with your tax advisor and ask that question, does it make more sense to me to do all my money in pre-tax or all my money in Roth? Or some companies say, put half and half. They let you split that contribution if you want. So that's going to be dependent on your plan. But Roth IRA is maybe the best tax advantage account out there.
What about retirement funds? Because a lot of people took a hit in 2009. They're looking ahead to 2010. What can they do? What kind of changes can they make to get a bigger return?
Well, past shows we've talked about risk, and that's always what we're talking about. And I think that's what you have to be aware of. You have to also, coming into next year, look at expectation. Look what's happened over the last year. Think about this, and I think a couple shows ago I had mentioned it. The market at the trough of this year was down something like 25 or 26%. Now it's up 25 or 26%. So you have a 50% volatility range. So what you have to be aware of is that I don't believe that we're out of the woods yet. I think you still have to be cautious in your investing. So what I would be very smart is make sure that whatever risk you're going to take, you know that what the reward is, and you feel that you're getting rewarded for the risk that you're taking.
Oh, well put. Tony, thank you so much.
Yes,
Listen,
thank
if
you.
you want to contact Tony, all you got to do is log on to BarnumFinancialGroup.com. The information is on the screen, or just come to our website, WTNH.com. Click on Connecticut Style, and we will get you to Tony Torino. Tony, thank you so much.
And happy holidays.
Here.
You too. Thank you.
Thanks for being here.
All right, it's a Dance Party Friday. So
It is.
When Connecticut Style returns.
Stay with us.
Are you
We'll
going to
be right
dance?
back. Of course I'm going to. Don't I always dance? We'll be right back.